Good morning, and welcome to the Gelman, Rosenberg, and Friedman webinar series. My name is John Pace, and I will be moderating today's webinar. I'm a partner with the firm and have been working in the outsourced accounting and advisory services since 2005. This morning, we will be discussing the road to audit readiness. Our goal today is to introduce you to some of the major areas that your auditors will examine and to provide you with additional insight to help make your audit preparation go smoothly. All of today's presenters provide outsourced accounting and advisory service to GRF clients, and all have extensive experience preparing our clients for audits. Before we get started this morning, a few housekeeping notes. We want to let you know that this webinar will be recorded and will be made available after the event, so please be on the lookout for that. If you experience any technical difficulties, please use the chat function that is displayed in the window on the right side of your screen. You can also call WebEx at the toll-free number shown on the screen. There will be a 10-minute question and answer period at the end of the presentation. For anyone seeking CPE credit, please note that there will be a short survey at the end of the presentation and that you will be required to submit this survey in order to receive CPE credit. Additionally, we will be providing 3 code words during the webinar, which will also be required to receive CPE credit. The survey at the end of the webinar will ask you for these special code words, so please be sure to make note of the code words as we will not be repeating them. Please make sure to disable any pop-up blockers that you have enabled, as they may block the survey. Finally, the presentation is available for download at your convenience using the link provided on slide 3. So, let's introduce today's speakers. Presenting today's webinar are GRF partner Ian Schuman and GRF manager Eleanor Litwack. Both assist many GRF clients in the area of audit readiness and audit preparation. Ian has over 20 years of auditing and accounting experience and works with many different types of organizations, both nonprofit and for-profit. Eleanor Litwack has over 12 years of accounting experience and also works with many different types of organizations, including for-profit and nonprofit organizations. At this point in the presentation, I will turn the presentation over to Eleanor, who will get us started this morning.
Good morning, everyone, and thanks for joining us today. So the way we've structured this presentation is to go through the trial balance and focus on the big, most common areas that might apply to most of your organizations, keeping in mind that we have both for-profits and nonprofits on the line today. We'll give you some tips to prepare and a glimpse into how an auditor might think about each of these categories. So specifically, we'll go through receivables and revenue, prepaids, fixed and intangible assets, other types of assets, AP and accrued expenses, leases, other types of liabilities, and net assets or retained earnings. Throughout your fiscal year and certainly during audit prep time, it's useful to look at your books from the auditor's perspective. That will guide your accounting decisions and also help you with the level of documentation that you should be keeping. So on this slide, you could see the logic used by auditors when they analyze your balances and the individual transactions. You could go through these and think of your fixed asset list as an example. So number 1, existence occurrence. Does each item on your fixed asset list really exist? Number 2, complete list. Does the fixed asset list contain all of your fixed assets? Number 3, rights and obligations. Do you really own these assets? Number 4, valuation and allocation. Are they valued at the correct amount? And number 5, presentation and disclosure. Are the fixed assets presented properly and disclosed in the financials? So this type of auditor logic can help guide you as you prepare your audit schedules and make your final adjustments. We could start with receivables and revenue. Pull an AR aging schedule and go down the list. Are all of these receivables still collectible, or do any of them require being written off? Nonprofits should ask their development department and possibly others in their organization about pledges that haven't been recorded yet. Also, as you analyze your funding commitments, you should look for multi-year pledges, because if you have a commitment for year 1, 2, 3, and X for year 4, 5, and forward, you might need to record all of those multi-year commitments now if they're unconditional. Also, we commonly see adjustments for discounts on future cash flows of those multi-year pledges. So you do have to record that discount for years 2, 3, and forward. Also, remember to update your allowance for doubtful accounts if you haven't already. And in addition, you should record your in-kind revenue. So in-kind goods are pretty straightforward in that you just record them at fair market value. In other words, what would you have paid if you had to purchase those goods? In-kind services are a little different. They have specific GAAP rules as to when they're recorded and when they're not. So if the services were performed by a professional with that specific skill set, you actually would record them. So for example, if you have a lawyer that provides pro bono legal services, that would get recorded as in-kind revenue at its fair market value. But if that same lawyer were to volunteer to do something else, such as volunteer at an event or some other task, you would not record those volunteer hours. And finally, remember to look at your subsequent cash receipts, just as you know the auditors will, because you'll find that some of the cash collected in the next year is actually revenue that needs to be recorded in the previous year. So now we could get a little more specific on the different types of revenue. For nonprofits, as you know, grants could be classified either as an exchange or a contribution. An exchange is more like a vendor-customer relationship where you're getting the revenue for performing some service in return. So those types of revenue transaction were to be recorded as they're earned or as you perform the service. So in other words, if you receive money on an exchange contract up front, but you have not finished performing on that by the end of the fiscal year, that difference in what you haven't performed yet becomes deferred revenue, which is a liability on your balance sheet. And then the other type of revenue is just a contribution, which is unconditional, a promise to give. You're recording it up front, and that can either be restricted or unrestricted. So for a contribution that's restricted, if you haven't completed that whole restriction in your fiscal year, you would still record it as revenue, but the difference there would be held on the equity section in your temporarily restricted net assets. And Ian can expand a little on that.
Yeah, I think this is an area that's a really important issue for a lot of our nonprofit clients, so it's probably worth spending an extra minute or two here. You know, one of the things we did to prepare for this webinar was just to go around and talk to a number of our auditors and ask, you know, where in the client's records do you find yourself making adjustments to their numbers? And every auditor we talked to mentioned this question of exchange versus contribution treatment for revenue. And I think there's two reasons that this comes up so much. One is that there really is not a clear rule on this. And I always like to point out that if you look in the accounting rules, so for example, in the Audit and Accounting book published for nonprofits, published by the AICPA, if you look in that book for grant accounting or grants, it doesn't come up in the glossary and not even in the index. There's nothing there. The rule is just that you have to look at each award document and determine whether you're going to use the rules for exchange or the rules for contribution. So it's kind of a judgment call, and usually not terribly black and white. Usually there's kind of elements of both scenarios, and you're making a judgment call as to which one to use. The other reason is that if you think about not just the frequency that this comes up, but the dollar amounts involved. So if you take an example where maybe there's a grant agreement right at the end of the year, maybe in December, and if you haven't done any work under it yet, so you haven't spent any of the money, under an exchange scenario, you haven't recorded any revenue yet. If the auditors come in and decide that that's really a contribution, not an exchange, then they're going to record the entire amount of that grant agreement into your revenue. And depending on the size of the grant, you know, if you're lucky, that's a $500,000 journal entry right there. So it's very easy to have
a single transaction generate an adjustment that to you might just be a nuance of the accounting rules, but to the auditors, this is a material misstatement of your financials.
Right, and when you are making these decisions and determining what kind of revenue each contract is, you really want to document that. So if you're looking at PDFs, make a little note on the PDF, because if the auditors do have an adjustment, like Ian said many times, it's a judgment call and they will adjust. If they do have an adjustment, at least they'll see that you had proper procedures and internal controls in place to distinguish between different types of revenue and when it should be recognized. And you should also look at your contract revenue for the next fiscal year. The example on the right is a good way to show it. So in both examples, there are $100,000 contracts. They're just structured differently. So in example 1, the payments are milestone based and you receive 4 throughout the year, or it even crosses fiscal years. In example 2, the contract revenue is just broken out by budget for salaries, travel, supplies, overhead. Regardless of when this $100,000 is actually funded, the revenue for these is recorded based on how much you completed during each fiscal year. So you could have a contract that you started working on last year, but you didn't sign the contract or receive the money until this year. You actually do have to book that revenue either as AR and unbilled receivable because that's an exchange contract and you did start working on it. You've already earned that revenue. You should also take a close look at sponsorship revenue for proper accounting treatment. Some sponsorships are just like contributions. So we call it a sponsorship, but the sponsor really receives nothing in return. In that case, you would record it at the time of commitment. So for example, if you get a sponsor to commit now for your event that's next year, that revenue is recordable now. But the other types of sponsorships are more like an exchange where you are providing something of value. So for example, you might have an event sponsor that it's at a high level, $25,000, and it comes with company swag, event tickets, and other things that the sponsor otherwise would have had to pay for. So what you should do is assess a value to what they're receiving, and that is your exchange, and you would recognize it at the time that the exchange takes place. So for an event, it's usually your event date. Also, if material enough and you have a large sponsorship that's actually a mix of an exchange and a contribution, you would separate those two and track the revenue accordingly. So let's move on to prepaids. Some of you actually track prepaids very closely throughout the year and you adjust for them each month. Others only adjust prepaids at the end of the year for the audit, which is fine for most cases, depending on your reporting needs throughout the year. But when you are preparing for your audit, you're going to want to scan your large fourth quarter expenses and actually your large expenses for the whole year to determine if any of those aren't actually a current year expense. Do they belong in prepaids? It's a good idea to look at your recurring monthly vendors and count the number of months that you expense during the year. So for example, if you're looking at your telephone expense and you have 13 months during the fiscal year, you might possibly have a prepaid there that needs to move out of the fiscal year. Also remember to look at your credit card transactions for prepaids. Most credit cards don't properly close at the end of the month, meaning the statements are dated in the middle of the month or earlier in the month, and Ian will expand on credit cards later. But for this purpose, if you're getting in all your credit card transactions for the end of the year so that you have the proper credit card balance on the books, that is good, but you have to make sure that those transactions are all actually expensed in the proper year. So you might have booked travel for next year and you have large hotel charges on those credit cards. Make sure you book those as prepaids as you're entering your credit card transactions. And finally, you should have a schedule showing everything in prepaids, and the ending balance should tie to your trial balance.
Okay, thanks, Eleanor. At this point in the webinar, we're going to take a brief break and address our first polling question of the day. And so today's first polling question is, have you ever had to reschedule your audit? So A, have you ever had to reschedule your audit? Yes. B, no, C, I don't know, and D, what's an audit? So we'll give the poll around 60 seconds or so for you folks to answer, provide your answers. And one of the things we're looking to know here basically is whether you really felt that you weren't quite ready for your audit and thus had to reschedule. And if you're perhaps a company or an organization that hasn't yet had an audit, one important thing to keep in mind is that rescheduling can sometimes be pretty difficult, as most auditors are usually booked months in advance. So, you want to just kind of think about, if you call up your auditor about a week or so before the audit's supposed to start, the odds of them being able to reschedule are kind of low. So just keep that in mind. And also today, while you finish answering the polling questions, we want to give you today's first code word. So the first code word of the day is summer. So please make note of that and add that during the survey process at the end of the webinar. Again, that code word is summer. Okay. So at this point, just scanning the responses, it looks like the vast majority, the majority of folks have not had to reschedule their audit, but at least 27 of you have had to reschedule your audit. So we know that there are some times, and there's facts and circumstances in life that make rescheduling the audit necessary, but it's something to pay attention to and to keep in mind. So I think with that, we can close the poll. And I can turn the presentation back over to Eleanor.
Thanks, John. So we can move on now to fixed and intangible assets. What you want to do is go down your list and assess that fixed asset list to make sure there are no disposals that you're still including in your fixed assets. So if you sold any assets or junked them for other purposes, you're going to want to adjust for that. You should display it in your list accordingly and also adjust it off the books. Also, you want to verify that you use the correct methodology for depreciation and for capitalizing your assets. There are different GAAP choices there, so if you're not sure which method your organization uses, you could check your last year's audited footnotes or check your accounting manual, and you might find that information there. Also, it's really important to assess your vendor contracts for potential capitalization. A lot of times those fall through the cracks because they just run through normal AP and they're expensed. But if any of your vendors or subcontractors are providing something of value that's going to be valuable for more than a year, that probably needs to be capitalized. A common example here is web development. There are actually specific GAAP rules as to the different pieces of web development and whether you expense them or capitalize them. But in general, anything that's the design or redesign of your website is capitalized and amortized over the estimated useful life of your website. And then you have planning and content development costs and other types of website costs that are expensed. So some of this is a little hazy and might be complicated. So if you're unsure, it's best to check with your auditors throughout the year or your other outside accountants because they could look at the document and then tell you what part of it you capitalize, what part you expense, then you won't be scrambling at year end to figure it out. And finally, you'll want to reconcile your total assets by category and your accumulated depreciation to make sure that everything ties to the trial balance.
Okay, that's going to bring us to just some other parts of assets that we wanted to touch on. And here, we have a couple of topics. The first is cash. Obviously, with cash, you want to have done your bank reconciliations and be current with those. Also, a reminder that you want to do some of the bank recs into the following fiscal year. You never know when you're doing the bank rec, if you did miss something for December, then when you're doing the January, February, March bank recs, that would show up there usually. So that's a good, just adds a little more comfort that you didn't miss something from December. Also a reminder that on your bank rec, don't just stop when you have the difference to zero. You also want to really examine those outstanding items and go through, for instance, on On the outstanding disbursement side, you want to look at anything old, more than a couple months old maybe, and make some determination which things maybe are just accounting mistakes, which things maybe are just stale checks that you want to reissue, but you want to go through and maybe clean up any of those older outstanding items, particularly on the deposit side. These days, there really isn't any deposits that take more than a few days to clear. So if you look at a bank rec and you see an outstanding deposit that's a week old or more, it's more likely than not just a mistake that you need to clean up. And a reminder here, and this really applies to every schedule that you do, but particularly it comes up with cash, maybe because doing that bank rec is usually one of the first things you do in the close process. But at the end, before you're finalizing the trial balance, you want to just go back and make sure that the register balance on your bank rec still matches the trial balance. You'd be surprised how often that comes up. Reminder under security deposits, your auditors will be looking at a copy of your office lease agreement. So if that agreement calls for a security deposit, then that should be on the books as an asset, and the amount should match what that agreement says. Inventory, that's something that if inventory is important to your business, then this is already a focus for you. The danger area here is some of our nonprofit clients that just have a little bit of inventory and it's maybe not a big number. Just a reminder that you should update that number and go through, have some sort of close process. Maybe you're doing an actual count or just some adjustment to that number. Investments, this is an area I think that a lot of people struggle with to get the number right and get the roll forward schedule properly. In a perfect world, what you're looking for, or what the auditors would look for, is some sort of schedule that rolls forward from the market value at the beginning of the year to the market value at the end of the year, with that balance matching your trial balance and the activity matching some of the related income accounts like the unrealized gain, the realized gain, dividends and interest, things like that. And those matching to the trial balance from that schedule, but also tying back to those investment statements. Usually on the investment statements, they give you some year-to-date activity numbers. I know investment companies like to make these things hard to find, but it is, if you can get those three pieces tying together, then that's what we're looking for with investments. Moving on to the accounts payable and the liability side, I think the biggest thing with AP is that you can be assured that the auditors will be looking at all of the activity, the payments and the recording of AP in the next fiscal year, looking for any costs that relate to last year. So you always want to have done that before they do. This is this search for unrecorded liabilities. General reminder, the expense should be recorded based on when the expense is incurred. So we're looking at service dates, not invoice dates. This is kind of the definition of accrual accounting, but it does come up where even if a vendor billed you in February for something in December, if they did the work or delivered the goods in December, it's a December expense. We also focus on vendors that bill monthly. So if you have vendors doing on some kind of contract that are doing monthly work, so this could be independent contractors, consultants, or professional services like lawyers or accountants, then here it's a pretty simple scenario. You're looking at which month had they billed you through, and just making sure that if they're working through the end of the year, that you've recorded the expense through the end of the year. That some of my more savvy clients might have a schedule that just lists the various monthly billing vendors so that they can keep track of that. And if you've got vendors that maybe haven't billed you yet and you need to close the books for the audit, then you should be doing some sort of estimate. If you can estimate that number and book that, then that at least captures that. And then the difference between the estimate and the actual hopefully is immaterial, and you just run that through the following fiscal year. You also want to look at expense reports. Here the dollar amounts don't tend to be as much, but it's particularly for employees or board of directors maybe. This comes up a lot. People like to hoard these expense reports. So if you have some way to go through and just get people to get all those expense reports in, that definitely comes up a lot. That's going to bring us to our second polling question.
Great, thanks, Ian. And the second polling question of today is, what accounting software does your organization use? Do you use QuickBooks? Do you use Intact? Do you use Microsoft Dynamics, which could be either Great Plains or Solomon, or do you use something else? And so, you know, with most of our clients, we would say that QuickBooks is still probably the most popular accounting software in use, except that we've also, with the emergence of the QuickBooks Online product, that many of our clients have shifted towards the online version of QuickBooks versus the old desktop version. And for those folks that may not have heard of Intact, Intact is similar in some ways to QuickBooks Online in that it's a cloud-based accounting software. It's marketed heavily by the AICPA, but it has a lot more functionality, a lot more project reporting modules within Intact, and it's also more expensive. So something to keep in mind, and it's a software that you will probably be hearing more about in the coming days. So, and also at this point, we want to take the opportunity to provide today's second code word. So the second code word of today is beach. So I think you can sense a theme happening as we approach a long holiday weekend. Hopefully everyone has a 3-day weekend coming up. So again, that code word number 2 represents hopefully the start of summer, which is beach. So that is our second code word of the day. And just looking at the polling results, not surprisingly, a large percentage of the respondents are using QuickBooks. But we also have almost equally large number of respondents that are using Microsoft Dynamics. So Microsoft Dynamics is going to be a more complex, more expensive, more powerful accounting system. So it looks like we have a lot of diverse usage of accounting systems across the folks on the webinar. So that's great to see. So with that, I will turn the presentation back over to Ian.
All right, thank you. I know I'm ready for that 3-day weekend, so I'm sure we all are. Okay, so another scenario for vendor accruals that we look at is vendors that are billing not on a monthly basis for their activities each month, but on more of a defined scope of work or deliverable basis. So in the example here, there's maybe a $50,000 contract. Some of the work is done in 16, some of the work is done in 17, and when you're closing your books, you have to assess what have they already billed you. So what do you already have recorded as an expense versus how much of this contract have they already done. So what's really incurred versus what's already recorded. And there can be a mismatch there. There's often a schedule for deliverables and then a separate schedule for when we're billing you, with something maybe up front or different times, or maybe all at the end. So this is the classic kind of scenario where maybe you put 50% of it in advance. They're 3/4 of the way done at year end, and you have that mismatch of 25%, so you're going to accrue that difference. Another area that comes up a lot is leases. And for leases, I want to start with pointing out that there are you may have heard that there's new rules for this coming out. The effective date of those new rules is actually, for most organizations, is 2020. for some entities, it's 2019. So there are still a few years where we're under the existing rules for leases. So we thought that this was worth talking about because it is something that comes up quite often. So the main issue with leases is the question of capital lease or operating lease. Briefly, an operating lease is one where we are going to treat the lease payments as expense as you record them. And then on the capital lease side, the accounting treatment is going to be that we're pretending that when you entered into that lease agreement, we're going to treat this as if you acquired that asset at that time. So you acquire the asset, you have a fixed asset, separately you've entered into a financing agreement to pay for that purchase. So two totally different scenarios. The way you go about this is that there is a test. There's a series of tests, actually. There's 4 tests, and you would look at every lease agreement, and typically this is for equipment leases. And you would have 4 things. If any one of these are true, then we're going to say it's a capital lease. The first is a change in ownership. So if at the end of the lease you retain ownership of the asset, of the equipment, then we'd call it capital lease. If there's a bargain purchase option, so if at the end of the lease you can buy the thing for $1, then that would trigger this. If the lease term is 75% of the useful life, then we're going to say you effectively just own it. Or if the present value of the payments under the lease financing part is 90% of the fair value of the equipment, then we would call it a capital lease. That last piece the last test rather, requires you to know the fair value, and this is worth pointing out and worth doing in advance. What comes up quite often is you have a lease, you're getting ready for the audit at the end of the year. To know the market value of that equipment when you sign the lease, this isn't just something you can look up on eBay. You normally have to go back to the financing company to ask them how much, what the value was. And usually they're forthcoming with that, but it can take some time. And I have seen that come up as just something that creates a delay where the audit is all but done, but we're waiting for that number so that we can finish this test. And then you would need, if it does pass the test and say it's a capital lease, then you would have to set it up as an asset. So you need to have that number. In general, with all of these, you want to have some kind of schedule that just has all of the payments, so you know which months and how much all the payments are for different pieces of equipment, because the auditors will need that information to put together the footnotes. On the other side with leases is the question, and this is more for office leases. Here's the question of deferred rent. The issue here is that under the accounting rules, under GAAP, the monthly expense is supposed to be the same every month over the term of the lease. So that is different usually than the dollar amount of the payment. Normally, of course, the payment starts at a certain number and then goes up over time with, as defined in the lease, maybe with inflation rates, whatever it is. But if those payments go up, then at the beginning of the lease term, you're paying less than the average number, and at the end, you're paying more than the average number. That mismatch becomes something we're going to call deferred rent, which is a liability. The way we calculate this is by looking at something like what you see here. We would normally have these side by side and with each month being a row, and then one column being the payments as they're actually scheduled in the lease, and then you would add all those up, divide by the number of months for the lease term, and then that would be your average number. keep in mind that certain lease incentives, and this is where maybe at the beginning of the lease you have a certain number of free months. Those months are part of the lease term, so they would be built into this schedule. And you would have, in those couple of months that normally at the beginning, you're going to have maybe a substantial difference between the payment, 0, and the average number. So this liability can build up very quickly at the beginning of a lease, and then at some point it tips and starts going back down to 0. Another thing that comes up is build-out allowances. This is a little bit different. This is where maybe the landlord gives you an allowance of a certain dollar amount for the renovations to get the suite ready for you. And in that scenario, that's actually built in here, not to the deferred rent, but it becomes a separate number that is amortized over the life of the lease through rent expense. And on the other side of that transaction, creates fixed assets for you to track, whether it's leasehold improvements or maybe furniture, things like that. So these are some things that often get missed, or even just that year-end adjustment to the deferred rent number. And here's our other polling question.
Great, thanks, Ian. So our third and final polling question of the day is, how concerned is your organization about potential management letter comments? So are you not very concerned? Are you somewhat concerned? Are you very concerned? Or are you not sure what a management letter is? So here we want to talk about the management letter, which is an output. It's part of the product that you get if you haven't been audited and you haven't gone through this. It's a letter that your auditors will generate, and they generally will list the findings, and I'll summarize and say it summarizes issues that they may have had with the audit. So we'd like to know what you think. Many of our clients are very concerned about the management letter and what the comments mean. We do have some that don't seem to be very concerned about them at all. And as providers of outsourced accounting and advisory services, and as consultants to help our clients be ready for the audit process, we personally view the audit management letter as somewhat of a report card. So we want to do our best to make sure that our clients are not getting any significant management letter comments. So while you answer questions provide your answers to this polling question, we want to give you the third and final keyword or code word of the day. And keeping in theme with the upcoming holiday weekend, that code word is wave. So once again, that code word is wave. And now we'll summarize the results of the poll. So actually, somewhat surprising, a fair amount of folks are not very concerned about the management letter. So it looks like it's very evenly distributed across answers A, B, and C, and it looks like most everyone actually knows what a management letter is. Some folks have not answered yet, but it is interesting to see that some of you are not very concerned about your management letter. So with that, we will turn the presentation back over to Ian.
Thanks. Yeah, I've always found that one an interesting one. I think a lot of my clients, since we're on the outsourced accounting side, getting them ready for their auditors, a lot of my clients, when I'm dealing with working with management, they tend to see the management letter as a report card, and their goal is to have nothing on the management letter. My colleagues here and the auditors, they see the management letter as something useful to their clients in providing a service. So it's, we come at it from different perspectives. So I'm not surprised that there's a range of answers there. Continuing with the liabilities, some other things we see here. First one, notes payable. With notes, you want to make sure that you have the documents related to notes. So this is the agreement with the bank that has all the finance terms. All that stuff goes in the footnotes, and it should have some sort of amortization schedule, maybe that you're creating or maybe that the bank created for you. But that amortization schedule determines how much of your payments is going against the principal, how much is interest, and that schedule should tie to the trial balance, and that's important to have. Another issue that comes up is payroll liabilities. This used to be a really big issue in the days where a lot of entities had biweekly payroll, because that created a mismatch where there were days in one year that were paid in a following year. And that's a classic accrual scenario. Doesn't happen nearly as much anymore as a lot of entities went to a 15th and 30th payroll. But if you have any setup like that, maybe for your non-exempt employees or if you're on a biweekly system, then you definitely want to make sure that whatever payroll is run, you're looking at the pay periods, not just the pay dates. Related to that is retirement. So you want to have, if there is an accrual or if there is an employer retirement contribution or an employer match, then whatever payroll related to the fiscal year, the related retirement part should also be captured and accrued into that year. Accrued vacation. Here, this comes up a surprising amount. The issue is if you have a vacation policy that allows employees to accrue vacation and it's paid on termination, then you need to accrue that as a liability to your financials. And it's almost as if, it's a liability as if all of your employees quit, on January 1st. So this is what you'd have to pay out. So you're looking at each employee, their hours of accrued leave, looking at their current salaries, and that's one area that auditors will look at to make sure that you're doing the calculation based on the current salaries at the end of the fiscal year, converting those to those number of hours into dollars, and then add those up, that's your accrual. Another issue that comes up a lot on that schedule is if your policy has a maximum, so maybe somebody has an accrual balance of 180 hours, but your policy says the maximum is 160, then the accrual should be based on them losing that excess number of hours. And that's something that is pretty easy to miss doing. Keep in mind also, if you've got somebody in that scenario where they're over the limit, you can draft a memo to the file. And this would be a memo just saying from management, we know that employee so-and-so is over the limit, and we're making an exception for the following reason, and so they are not losing those extra hours. And that's fine. If you've documented that, put it in the file, the auditors will be fine with that. Finally, here is corporate credit cards. We touched on this earlier. The issue with credit cards is just that the statement dates often don't really line up to calendar months. And it's easy to forget to do that, where if your statement ends on, say, the 23rd, then the charges from that date to the end of the month that are on the next credit card bill, you need to go through those and capture those into the right fiscal year. And like Eleanor talked about earlier, keep in mind you're recording these, all the normal accounting rules apply. Those could be prepaids or whatever, maybe they're fixed assets, but you would evaluate those just like normal. And finally, with these and any schedule I mentioned earlier, you definitely want to go back and make sure that all these schedules match the trial balance. I always think it's also useful just to have somebody else look at it. Even if you're the only one that works on it, it's helpful to have someone else involved just to look at these schedules in a review capacity before they go out. It's easy to miss stuff when you're the only one looking at it. So the last area we wanted to touch on is net assets, or the equity section. The big point here, and again, this was mentioned by every one of the auditors that I talked to prepare for this webinar, the big issue is that the numbers in your trial balance in total, those should exactly match what it was in last year's audit. So if the equity ended last year at 105,000, that should be the number on the trial balance now. It's easy to have things that run through there, like for example, maybe you didn't record last year's journal entries, or maybe you posted something to last year after you sent the numbers to the auditors. Or if you're a nonprofit, some nonprofits like to run the restricted activity through the equity just to keep it out of the way. But that stuff, it shouldn't, your net assets number shouldn't change from last year's ending numbers. The second point for nonprofits, if you have restricted net assets, then keep in mind you've got to have some sort of schedule or some way of tracking what's restricted, what it's restricted for, and then calculating how much should be released of that for this fiscal year. Eleanor, I think you touched on this a little bit earlier with revenue.
Yeah, and releases from restriction in particularly are very heavily tested by auditors. So you want to make sure that those are documented properly. So some of the releases might go through your natural AP cycle, and therefore the expense is coded against the restriction, and that's fine. But other releases are done by journal entry or by allocations, and just make sure to document those properly, because most likely if they're large, they will be tested by the auditor.
Yeah, thank you. This is definitely something that that is likely to be tested, and the documentation for that could be letters from your donors. It could be maybe it's just a program and you need to show how much was spent on the program, but whatever it is, you should have that stuff laid out. Finally, here I should mention that for the nonprofit world, there are new rules coming for this. They're actually coming for next year. Those rules are somewhat comprehensive. They touch a lot of areas, but in terms of net assets, what they would do is combine temporarily restricted and permanently into one area that is just called net assets with donor restrictions. So there are lots of other rules there, but for this purpose, it would combine those two sections. And finally, I wanted to mention to remember that board designated net assets are part of unrestricted. The restriction itself, any restriction by definition, has to come from outside the organization.
Great, thanks, Ian. Well, we're going to enter into a question and answer period at this point, but before we jump into the questions that have been submitted, we wanted to let you know and offer you to join us again at the next webinar in our 2017 series entitled Exit Planning, Preparing for the End from the Beginning. This is going to be on June 27th, 2017 from 11 a.m. to 12 p.m. And so this will probably, for those folks that are with for-profit organizations, businesses, this is more likely to be up your alley as opposed to some of the nonprofit folks, although it could be relevant for the nonprofit folks as well. So please join us again for our next webinar. And now let's get to some questions that have been submitted, and all of us, Ian and Eleanor and myself, will all weigh in on the answers to these questions. But the first question that we have today from users is there a difference, are there differing rules for different size nonprofit organizations? So is there a standard that applies to a smaller nonprofit that doesn't apply to a larger nonprofit? So let's kick that off. Eleanor, do you want to address that one?
Yeah, sure. It's a good question. Generally, the accounting rules are actually the same, with the exception of an organization that's funded by the government. So if you have $750,000 or more of government funding, then your audit would fall under the Uniform Guidance Rules, or formally A133. But aside from that, the general accounting rules would be the same. But you do want to keep in mind that there would be different materiality thresholds. So for example, a $15 million organization might not adjust for a $1,000 or a $5,000 piece of revenue or expense that's in the wrong period, but a $1 million or $2 million organization might actually adjust for a transaction that's $5,000 or $1,000.
Yes, and to bring this, to bring this around to for those folks that are working for our traditional for-profit clients as well, we often field the similar question, and the question is typically from a business owner that's something along the lines of, I'm a small business owner, maybe I have $1 million or less in revenue. Do I really have to do this, or really does this have any impact on me? And the technical answer is GAAP is GAAP. So generally accepted accounting principles are generally accepted accounting principles regardless of your size. So that's something to keep in mind that there really isn't a size differentiation. So great. Okay.
Go ahead. I think what I would add there is that, and this is maybe a little out of the audit prep theme for this course, but for smaller organizations, you might not have a requirement for audits. So there are some nuances that maybe smaller clients, if you're not doing an audit, then you might not bother with. Or keep in mind also that you can do audits. They're almost always on the accrual basis, which is the basis for a lot of the adjustments that we talked about today. But we can do audits that are cash basis. That does exist and does happen, and maybe would be appropriate for smaller but not larger groups.
Right. Thanks, Ian. Okay, we got another question from one of our attendees. And at what point? And that question is: at what point is a transaction really just too small to consider adjusting for in the course of your audit prep? So, Ian, why don't you address that question?
Yeah, I think what I would offer there is that, and this gets back to the concept of materiality. The auditors will do some calculation where they determine how much, what's material to the financial statements and how much is material enough to look at on an individual transaction basis. They're not going to tell you those numbers, but you can make your own determination as to how much is so small, and that would normally, that's very often in the text of accounting rules. It will say this need not be applied to immaterial items. Keep in mind, though, that a whole bunch of immaterial items can add up to something material. So that occasionally comes up where maybe if you're dealing with prepaids or something, if you have a whole lot of things that are all individually under the number, then maybe in total you should be recording that.
Okay, great. Thank you. Okay, we have a third question from our attendees today, and that question is: can you discuss the treatment for those nonprofit organizations? Can you discuss the treatment of membership dues? How should membership dues be treated in terms of revenue recognition?
So those actually also need to be assessed for whether it's an exchange or not. For some membership dues, the member doesn't receive anything of value for being a member. It's just more of a membership type relationship. And in that case, it's a contribution, so you would record it up front. But for true memberships where you're getting something, whether it's a magazine subscription or something else from a nonprofit, that would be recognized that you would defer the membership dues if you need to. Like if they're received up front, you would spread them over the period of membership that they apply to.
Great. Great. Okay. Wonderful. So thank you very much for that. Great. So we want to thank you for your time today, and we want to give you ways that you can get in touch with everyone on the webinar. You have the contact information for Ian, Eleanor, and myself, as well as our website and our presence on social media. As we mentioned kind of during the webinar, this is we call it it's an ongoing webinar series throughout the years, so please stay tuned to all kinds of different topics as it relates to accounting, auditing, tax, compliance, those type of areas. So we really want to thank you for your time and attention, and we look forward to seeing you on another GRF webinar. So thank you very much, everyone.